Hello, and thank you for joining us for part 3 of a 3-part series where we're discussing risk management for natural gas. In the first 2 segments, we discussed the different kinds of tools that were available to the end user to help mitigate this risk. In this section, we're going to learn how to pull those tools together given different market situations to create a prudent risk management strategy. In review of what we learned, index price, or doing nothing, is a short position to the market, and it exposes the end user to an unlimited risk, and that is of market prices rising. The good news is it allows the end user to take advantage of a falling market. And as we demonstrated, index price is a good thing to consider when you're in a high price environment, a very poor thing to consider when you're in a low price environment. Fixed price is a long position, and the benefit of it is it completely eliminates the end user's risk to rising prices. But it also eliminates the end user's potential to benefit from falling prices. And so fixed price, as we learned, is very beneficial and very prudent to use in a low price environment, probably not so much in a higher price environment. Then we talked about options, and we talked about buying call options and selling put. And we talked that a good time to use options is when you're in a mid-range, a price mid-range, where it's not clear-cut on whether I should buy a fixed price or whether I should be all index. Kind of in that mid-range of the market can move quite a ways both directions. That's when we need to start thinking about options. A call option provides protection from rising prices, but it also keeps the door open to enjoy falling prices should the market go down. A put option, and if we're the seller of a put option, which we would be, that allows us to receive money. It allows us to receive a discount from index gas, and in return is what we're giving up is the right to take gas at some low level. And so we're giving up the floor, but in return, we're making a discount off our normal gas purchases. Combining both purchasing a call option and selling a put together establishes a collar. And so under a collar, we'll have bought a call option with some particular upper limit protection, the strike price, and we'll have sold a put option at some lower limit for which we're somewhat indifferent on whether the price hits and drops below. As the market fluctuates, our price is contained within the upper limit of the call and the lower limit of the put option. All right, moving on into how to implement these given different market conditions. First thing I like to do is divide the market up into three areas. That would be a low, medium or intermediate, and a high level. Before I talk about the different tools that are appropriate in these different price ranges, let's talk about how we get these price ranges. They are for sure not arbitrary, and they are for sure not set on what historical data. What they are set on is some very steadfast support and resistance levels that we find in the natural gas market. In all markets, there's support and resistance levels, and in a lot of markets, frequently they're established due to more psychological or technical reasons. While some of that does occur in the natural gas market, there are some strong fundamental reasons for the resistance in the floor. As we start having prices drop towards this 250 range, really anything below $3, it starts putting stress on the production side of the equation. It starts to get not profitable, less than $3, and as we approach that 250 level, it's very hard on production, and shut-ins are taking place where they can. Infrastructure dollars are drying up, and so we start losing production. At the same time, we start gaining demand. Those people that were burning coal, and because it was the cheaper fuel, as price dropped below $3, gas starts to become the cheaper alternative. So we have a production decrease and a demand increase. As prices turn and go the other way, the exact opposite happens. Production starts ramping up. As we cross that $3.50 level, every molecule that can flow is flowing out of wells. And at the same time, we get a demand decrease, because as we cross that $3 mark and start heading up towards $4, we start getting people switching back to coal and foregoing natural gas. So we get a demand decrease and a supply increase, and what does that do? It turns the market right back around. So we have pretty strong rails of support and resistance. Certainly prices can go above and below on intermediate basis, but these rails are fairly well established in the current market conditions that we're in. All right, let's go back to our strategy. Let's first talk about the low price environment. Quite truthfully, if you got prices at $2.50 or below, shouldn't think about anything else but fixed price, right? Minimize level of call options, no need for them. Minimize level of index. The market can't give up much from $2.50 downwards. You want to lock in, and not only do you not want to lock in for a lot of your volume, if not 100% of your volume, you want to lock in for a long time. When we take a look at the other end of the spectrum, prices on the high side, we for sure want to minimize our level of fixed price, right? Don't lock into a bad thing. We want a moderate level of index price to take advantage of a falling market, but we still want a moderate level of call options. Why? Because we know prices can still go up from any point, right? Let's take a look at the mid-range, where it's maximize level of call options, moderate levels of fixed and index. And what probably should be written there is we want to look at a real diversified portfolio in this range. And let's take a look at what that looks like. If we were diversified, a third index, a third fixed, and a third call option, it's labeled capped up there. First of all, and I'm going to show you the benefits of both a rising and falling market of this diversified portfolio. And you might want to think of this in the same light that you view diversification of your own investment portfolio. One element, though, that I will comment before we go any further is I talked to you about the benefits and the virtues of call options, and that I could make an argument that 100% call option strategy is a prudent strategy, which it is. The issue there is that call options have a cost. And by just using a third of the call options, obviously your portfolio is just experiencing a third of the price. But we'll see how implementation of call options along with these other tools provides for a pretty safeguarded portfolio. In the event that prices rise, 2/3 of our portfolio is protected from rising prices. Clearly the call options tap out at their strike price and essentially become a fixed price. The fixed price doesn't budge at all, it's fixed. The only exposure we have in a rising market is 1/3, and that's the part that we're buying at index. Now then, if prices should fall, it's beautiful because 2/3 of our portfolio will fall right with the market. Clearly, everything we bought under a call option will fall right with market. Everything at index will fall with the index, and the only thing we'll be stuck with is fixed. So what you can see is, under a diversified portfolio with the inclusion of options, is you're guaranteed to be right 2/3 of the time. 2/3 of your portfolio is fully protected from rising prices, and will 2/3 fully take part in a falling market. And in this portfolio, keep in mind, we can always sell put options to further offset the price of the call options without any detriment to the portfolio, other than it would put some amount of floor here on how much we could enjoy prices falling if they should do that. In general, I included this graph. It's kind of a risk-reward graph on it, and typically I would show a line at where the current price is now. And let's just say that the current price was at $270 on this. And what this is showing is at $270, the amount of risk is the price rising this way. The amount of reward by doing nothing is that it falls down towards the $250 mark. The whole point here is that when you're in this area, we should be thinking of that diversified portfolio. As we move this way on the graph, start increasing fixed price and lessening index and call options. As we move this way, start decreasing fixed price, decreasing call options, and increasing your index price. If we find ourselves to the left of this line, be 100% fixed price buyer. If you find yourself to the right of this line, be no fixed price buyer. Focus on index and call options. Well, once again, thank you for joining us for this presentation, and I hope that you watched all three of them. And that will conclude it for today. Thank you.